Ira Jersey with us from Bloomberg Intelligence, Chief US Interest Rate Strategist. Ira, your thoughts on what we just heard in the last 10 minutes or so?
Yeah, so I have not looked at the employment cost index. I've been focused, very keenly on the quarterly refunding announcement, which did have in the details a few little surprises. So what it particularly for me, and that was that the Treasury Department is going to be increasing 2-year notes and 5-year note offerings, which will happen at the end of February, more than certainly we had expected. So they're actually increasing 2-year notes $3 billion a month for the next 3 months. So that's another $9 billion of 2-year notes. That we're going to get up to $69 billion every auction, which I'm pretty sure is a record. If memory serves, 67 was the old record. So even though deficits are certainly moderating slightly compared to what they were in the second half of last year, and becoming much more seasonal and normal, there's still going to be this net issuance that the government has to do. The other big thing was the announcement that they are going to be starting buybacks in the next quarter, it sounds like, and if they do that, then they'll probably have to increase the on-the-run coupon auction just a little bit more, and in order to conduct those programs. But keep in mind that might actually help market liquidity a little bit, which hasn't been particularly good of late, John.
What's the significance, Ira, of increasing the 2-year and the 5-year maturities in terms of just what the market is prepared to absorb? I'm not seeing that much reaction in markets, and if anything, yields were lower on those maturities after this announcement came out.
Yeah, I'm not sure why everyone decided to go buy 2-year yields, 2-year notes when they're going to be a lot more supply. That didn't quite make sense to me, and I think that'll get worked out over time, particularly when we see the auctions themselves. So I think there's two things. I think one is there's an acknowledgement by the Treasury Department that they've been issuing a whole lot of T-bills, and they don't want to have to issue quite as many as they have during past quarters. So by increasing that short end of the curve, so 2s, 3s, and 5-year notes, that will allow them to issue less T-bills. We had been expecting about $400 billion of T-bills to be issued this quarter on net. They guided to $300 to $350 billion. So you're talking about $50 billion less in T-bills than we had anticipated. So I think that's the discussion. Basically, they're starting to term out the debt a little bit here, and I think as interest rates come down further, the Treasury Department will look to term out the debt even more and increase the average weighted maturity of all of the Treasuries outstanding, because that's shortened quite a lot as they've issued a couple of $1 trillion of T-bills over the past couple of years.
Ira, I'd love just stepping back your view on what the Treasury Secretary has done with respect to some of these borrowings in terms of actually surprising to the downside how much we're going to be borrowing in the first quarter, and then pushing that out in potentially medium-sized duration, all of these sort of machinations to try to keep some sort of common markets. Do you think that it seems like it's savvy, or do you think that it will sort of be the bill that hits later in the year when we have to increase issuance that much more?
Well, I think there's a couple of things. One, keep in mind that the amount that the Treasury Department raises has to do with what it thinks the deficit's going to be for that quarter. So that's not a choice that Janet Yellen or anyone at the Treasury Department makes. That's actually a choice that Congress makes, and it just happens to be that they're going to be about $56 billion less of the deficit this quarter than they had projected 3 months ago. By the way, I thought that there would be a lower deficit than there was. So it definitely surprised the consensus, but it didn't surprise everyone that there's going to be slightly lower deficit. The other thing is, and I think that there's some people in the market think that the Treasury Department is doing something unusual in issuing all of these T-bills. If you go back to the 1980s through now, the Treasury Department almost always increases the amount of T-bills as a share of their portfolio when interest rates are high, and then when interest rates are low, it terms out that debt. You could argue that maybe they should have done a lot more 10-year and 30-year debt when interest rates were near zero. Sure, you can definitely say that, but at the same time, this is a very typical cycle that the Treasury Department does. The difference now between now and, say, those prior cycles is that you normally don't have growth as strong as it is with deficits as high as they are, right? Normally deficits are low when growth is as strong as we've seen it the last couple of years. And I think that's a major difference between this cycle and others is that you don't expect $760 billion of net borrowing when nominal GDP is running at 5%, right? That just is not a normal environment, and I think that that's a bit of a challenge for Treasury in trying to manage how much it's issuing of different debt and keeping the cost to the taxpayer in terms of interest rates low, because that's hard to do when interest rates are at 5% for short-term debt and 4% for longer-term debt.